So we already know about options, forward contracts, future contracts, swaps, and other types of derivatives. And I also talked about CMOs, CDOs, CDS, and similarly MBS and ABS. And I asked you last week to actually have a look and see what they are, because we will be talking about them and we will be referring to them here and there. So we need to be aware of that. I'll be discussing them time and again. Okay, so we know about options. Last week we defined option to be an agreement where one party has the right and the other party has the obligation to buy or sell something at a specified price within a specified period of time or at a specified date. So we said that because an option gives the buyer the right to do something, so the right to do something will not be uh, free of cost. As we discussed, there are no free lunches in finance. So the right to buy or sell will not be given free. So there will be a buyer and there will be a seller for an option, whether a call option or a put option. So the buyer will have to purchase this right from the seller. And to purchase this right, the seller will have to receive and the buyer will have to make a payment of the premium, which is called a call premium if it is a call option, or a put premium if it is a put premium. However, in our module, we will be not referring to it mostly as premium, but we will be referring to it as a price of the call and a price of the put. Okay, however, these are the same. Premium of the put, or put premium or call premium, or price of the put or price of the call. Then in the option, we said that we have the right to buy or right to sell something. So the right to buy, as we know, is called the call option, and the right to sell is the put option. The right to buy is at a given price, or the right to sell is at a given price, and normally we denote it with an X, which means exercise price, which is also known as the strike price. If I have the right to buy a share of a company for $100 or £100, this is the exercise price. This is the price at which I can buy. Or if it is a put option, this is the price at which I can sell. So this will be the exercise or the strike price. Then the expiration date is the date on which the option will expire. So if I have the right to buy or the right to sell the shares of Apple in 3 months time, so 3 months is what we call the expiration period. Okay, and the day on which this option expires will be the expiration date. So 3 months later, let's suppose on 2nd of April, the option will expire. So the option period or the expiration period is 3 months and the expiration date is 2nd of April. That's the day after which this option is lapsed. So option has a limited life. Uh, if the option can be exercised within the 3 months at any time, it is called an American option. Okay, exchange listed options are American options because exchange listed options can be exercised at any point of time before expiration during the trading hour. So that is why we call them American options, because early exercise can be possible. So though the option has a 3 months period, but it is trading on an exchange and it is an exchange listed option, it can be exercised at any time during the 3 months period. On the other hand, a European option is an option that can only be exercised after 3 months or 6 months or whatever the period has been set in the contract. So at the expiration date, if it is worthwhile, the call or the put buyer will exercise their right. Otherwise, they will let it expire out of the money. So the American option can be exercised at any point of time before expiration during trading hours, and the European option can be exercised only at expiration. Most of the options, I mean, like all the options that are exchange listed, they are American. If let's suppose if I give you an example of a call option, let's suppose I have the right to buy 100 shares of Apple at 120 3 months from now. So in this, it's a call option because it is the right to buy. Size of the contract is 100 shares. So each contract here, for example, if this contract here has a size of 100 because it's giving me the right to buy 100 shares. The exercise price is $120 and the time to expiration is 3 months. And let's suppose the expiration date will be 2nd of April. If today this contract is initiated, let's suppose the spot price of Apple is $115. I have the right to buy it at $120. If you see, if it is a European option, I cannot exercise it till 2nd of April if it's a European option, because a European option, whether call option or put option, can only be exercised after the expiration or at the expiration date, and that is 2nd of April in this case. However, if it is an American call, I can exercise it at any point of time before expiration, provided it is worthwhile. So let's suppose 1 day later, okay, let's suppose I just write it T 3rd Feb. So if the stock price goes to $150 and I have the right to buy it 120, it will be valuable for me to exercise my right tomorrow. I can buy 100 shares of Apple for 120 and I can sell them in the spot market for 150 and realize a gain of $30. Because it is an American option, I can exercise it at any point of time before expiration. However, I will not be doing this. Even though it is in the money, there is a high probability that I will not be exercising my right before expiration. Even though it is quite beneficial on the 3rd of Feb, I will prefer to wait till 3 months time, that is the 2nd of April, okay, and see what the price is there. So let's suppose the price then is 180, okay. And in that case, I may realize a higher gain. How much is this? 60, for example. That is the payoff. Okay. We will talk about the symbolism and all that later, the symbols that I am using. And again, you may say price can go down. What if the price is 100 then? Or what if the price is 80 then? So you see, this is one thing that we will keep in mind, and you will get your answers as we move into week 3, week 4, and week 5 when we talk about the boundary conditions. For time being, as we discussed earlier, is that we here are doing risk neutral price. When expiration comes, you will be looking at whether the exercise price is greater than the spot price then, okay, or the exercise price is less than the spot price then, or the exercise price is equal to the spot price then, okay. Or even at any point of time, I mean, if you want to see an option even on the 2nd day or the 3rd day, or at any point of time, you just have to compare it against the spot price. At any point of time, if the exercise price is greater than the spot price, exercise price in our case was $120. So if exercise price is greater than ST, let's suppose ST is 80 or S is 80. That is the spot price in the market is less than the exercise price. Will you exercise your call option? Will you be willing to buy Apple's share for 120 that you can purchase in the spot market for 80? No, you will not be exercising your right. So in such a case, whenever the option has exercise price, the call option has exercise price greater than the spot price, we call it out of money. Okay. Why we call it out of money? Because here it will not be beneficial for the buyer of the call and to exercise, because the call price, the exercise price is 120, which is greater than what is prevailing in the market. If the exercise price is less than the price in the market, we call it in the money. For example, if in this stock market the price is 160 for Apple's share and you have the right to purchase it at 120 at any point of time during 3 months, if this is the case, you will call it in the money option, because here it is beneficial in such situations to exercise because you will be able to buy it at a lower price and sell it at a higher price, or you can buy it at a lower price than available in the market. Whenever the exercise price is equal to the spot price, this is called at the money option, call option. So here we will have the exercise price in the market, exercise price of the call in the call is the same as the spot price in the market. Whenever that is the case during the option life, it will be at the money. For the put option, again, we will have the same three concept, but this time it will be reversed because the put option is the right to sell. So whenever the exercise price is greater than the spot price in the market, we will have the put option in the money. Why? If you have the right to sell Apple's share for 120 and in the spot market, Apple's share is trading for 80, it is worth for you to exercise and sell at a price of 120 than to sell in the market for 80. Okay, because it is the right to sell. So the right to sell will be more valuable when the spot price is less than the exercise price. So in such cases, you see when the call was out of the money, the put is in the money. Then when X is less than the spot price, that is the exercise price is less than the spot price, in such case, the put option will be out of money. If you look again at the same example, if the exercise price is 120, that is the price at which you can sell Apple's share. But in the market, the spot price is 160. So it will be beneficial for you to let your option expire and sell your share in the market for 160. And again, if the exercise price is equal to the spot price, this is at the money put option, because the exercise price is exactly the same as the spot price at expiration. Now, remember, what we are talking here about is an important concept of moneyness. This important concept of moneyness is quite relevant. We will be doing the option pricing next week, where we will learn that the price of an option, call option or put option, is combination of two factors. One is called the intrinsic value of money, and the other is one is the time value of money, and the other is the intrinsic value of the call or the put option. So when we talk about the valuation of option next week, we will see that the value of an option is sum of these two. That is the time value of money and the intrinsic value. So the concept of moneyness is important for this bit. And we will learn how the time value of money is derived for call options and put options later. We know about forward contract. So it's a contract in which we fix the price for buying or selling the underlying in future. And here, as we said last time, that in an option, you see one party will have the right and the other will have the obligation. But in a forward contract, we will have one party with obligation and the other party with obligation also. So both the parties will have an obligation. That is why we say that options have what we call asymmetrical payoff. And we discussed this last week, where we said that the party with the right may have unlimited gains and limited losses, and the party with the obligation may have limited gains and unlimited losses. On the other hand, in a forward contract, both parties will have unlimited gains and unlimited losses possible. And this is why we say that forward contracts and future contracts, as well as swaps, they have symmetrical payoffs where none of the party is like in a better position because both have the same obligation. So their possibilities of losses and gains are symmetrical, like a normal distribution, half and half. Okay, so that is how they are different in terms of their payoff. If you want to actually replicate the position, now here you have the right, isn't it? In a call option, you have the right, but here you will have the obligation to buy. If I just write it like this, look, in a call option, the buyer has the right to buy and the seller of the call has the obligation to sell. And then in a put option, you have the buyer who has the right to sell. And then in the put option, the seller has the obligation to buy. So if I say, how can we equate a forward contract with call option and put option? If somebody is the seller in a forward contract or future contract, the seller in forward or future contract is exactly having the same position as the seller in a call option, because the seller in a call option has the obligation to sell and the seller in a forward or future contract also has the obligation to sell. Okay, then the seller in a put option has the obligation to buy. So this will be equal to the buyer in a forward contract, because the buyer in the forward contract has the obligation to buy. Okay, so this is how you can equate a call option and a put option to a forward contract, where the seller in a forward contract has exactly the same position and the same possibilities as the seller in the call option, and the buyer in the forward contract has the same position as the seller in a put option, because they have obligation to buy or obligation to sell. The forward price will be like, the forward price, we will see it later, that it will be relatively analogous to the exercise price in the call option or the put option. Okay, and later on when we talk about the put call parity and the advanced forms of it, we will be equating it to futures contract. There are two concepts that we have to actually focus in this module. One is the pricing and the other is the valuation. So pricing and valuation of derivatives are not the same. Like if I have this contract where I have a forward contract with you where I have the obligation to buy one share of Apple at 120 from you in 3 months time, and that is the forward price we have set today. Okay, this is the forward price we have set today. So this is the price in the forward contract. Now, remember, whenever we initiate a forward contract or a future contract, at the time of the initiation, that is when the contract is done, the deal is done, at that time, the future contract or the forward contract will have a value of 0. This is something that is the basics of valuations of futures and forwards, as well as when we go forward for swaps. However, this is not true for options. Okay, at the time of initiation of a put contract or a call contract, the value will not be 0 for them, and the reason is there is a right involved in it, the right to buy or the right to sell, so that will be carrying a price or a value or a premium. However, in a future contract or a forward contract or in a swap, what we will have is that whenever we initiate them, okay, at that point of time when we initiate them, they will have a 0 value. But as time passes on, the spot price will go up, the spot price will go down, because that is the underlying. It will result in creating value for the buyer or the seller of the contract. So at the time of the contract, when we initiated, the contract where I have the obligation to buy and you have the obligation to sell Apple's share for 120 in 3 months time in a forward contract, both the parties have zero value for the forward contract. So I have zero value and you have zero value. And let's suppose when we initiated the contract, the spot price in the market is $115. Okay, let's suppose. We will come to this later when we value it. But let's suppose if the price in the spot market the next day goes to 125, now the price has gone up. I have the obligation to buy and you have the obligation to sell. So it means I have made money on the contract. You have made a loss on the contract, and that will be reflected in the forward valuation where I will have, if I value the forward contract, I will have a forward derivative contract asset and you will have a forward derivative contract liabilities. If you remember when you were doing your accounting modules or when you were doing financial statement analysis with me, the annual financial reports, they had this thing, derivative liabilities, okay, and derivative assets. So if a company has derivative contracts like forwards or swaps in which the price has moved in its favor according to financial reporting standards, it values it and report it in the balance sheet as an asset. If otherwise, it will report it in the balance sheet as liability. Next is the forward price is the strike price where the call premium equals the put premium. Okay. Now, as we said, the right to buy Apple, okay, and the right to sell Apple. This is a call option and this is a put option. And let's suppose the exercise price for both is 120. So they will not be selling at the same price. Even the exercise price is 120. The call price and the put price will not be the same. So ideally, generally speaking, the call price may be higher than the put price. Or it can be the other way around, that the put price may be less than the call price, depending upon which options we take. If we select an exercise price such at which the put price is equal to the call price, the forward contract will have, that price, which will be enabling the put price to equal the call price. Now it's a bit technical, and this point of time you might be a bit wondering, but don't worry about it. I just have written what this sentence or phrase here means. It says that the forward price is that exercise price at which the price of a put option on the same underlying will be equal to the price of the call option on the same underlying. So generally speaking, in markets, call and put prices on the same exercise prices will not be the same. However, if you choose an exercise price such that if you calculate the price of the put and if you calculate the price of the call, they are the same. Let's suppose you will see later, I'll give you Excel models for the Black-Scholes and the binomial model, so you can experiment with this. Let's suppose you keep on putting in different prices. You start with 100, then you go with 105 and keep on doing it till 100 and let's suppose 140. At 100 let's make it 125. Let's suppose at 125 you get the price of the call option exactly equal to the price of the put option. Theoretically speaking, it will not be practically applied, but it is quite important later on. Remember, in this module we are going to talk about arbitrage, and everything we do will be based on arbitrage. So if this relationship is not whole, theoretically there are possibilities that there may be arbitrage opportunities. Okay, so somebody can take a long position in a forward contract and then a short position in a put contract, theoretically possible to exploit the mispricing. So the forward price is that strike price at which the price of a put option and the price of a call option will be exactly equal. Measure of a risk for a stock is beta, but the measure of risk for a call is, or a put is delta. And then the measure of risk for delta of a call or a put is gamma. Delta is the rate of change and gamma is the rate of change in the rate of change, like the first order derivative and the second order derivative, which is the rate of change in the rate of change. So it's quite interesting, and you will see such statements being thrown at you, and you have to actually sort of formalize them in these sort of expression to understand them. Then forward contracts are customizable. They are exclusively OTC contracts, so they are customizable. The terms and conditions can be made according to the requirements of the buyer and the seller in the forward contract. The downside of the forward contract is that they carry significant counterparty default risk. So because this is an OTC transaction between two parties, so any of the party can default.
So will you be showing us an example of the thing you've just explained above today?
Of course, we have 2 weeks devoted for futures and forwards, where we will be pricing them and valuing them. And I tell you, that is going to be an exciting time when you do that. Similarly, for options, we have at least 4 weeks to learn about options. Okay. So then we have future contracts, and we did talk about a future contract last time. We're going to talk about futures and forwards in detail. The difference, as I talked to you about it last time, is that in a forward contract, if I set the price here today, and it is, let's suppose, in 3 months time, so the price will remain the same. So if I set the price 120, it will be the same fixed price, 120. In a future contract, if I bought a future contract at 120 today at 11 o'clock, okay, the price will change the very next second if there is trading in it. Okay, and my gains and losses will be calculated at the end of the day, which we learned last week. We talked about mark to market or daily settlement for future contracts. So the forward contract, the gains and losses will be calculated only once at expiration. And in the future contract, the gains and losses are calculated every day, daily settlement, mark to market. Okay, there is no margin requirement for trading in forward contract. There is a margin requirement for trading in futures contract. And then we talked about few forward contract being exclusively OTC contracts and future contracts being exclusively exchange listed. Okay, and we know that forward markets are not that much regulated. Of course, they are highly regulated nowadays, but still lagging behind future contracts. And the other thing is that forward contracts, forward markets, OTC markets are relatively illiquid compared to futures market, which have the highest liquidity. And then there is counterparty risk in forward contracts because of the OTC nature of the contract. It's being between two parties. In the futures market, the counterparty risk does not exist because the exchange or the clearing house is actually the body that takes the default risk on itself. So this is how futures are different than the forward contracts. They are standardized contracts. You cannot change the terms and conditions. The exchange, the future exchange, will determine what will be the contract size, what will be the contract expiration, what will be the underlying, what will be the settlement and delivery procedures. All these are determined by the exchange. While in the forward contract, we see that it is customizable and the exchange has nothing to do with that. The two parties actually do it themselves, customize it according to their needs. The clearing house in any exchange, I mean, even if it's an option market, if it is an exchange listed option, or even if the stock market, the clearing house is actually the intermediary. So what happens is that, you know, if I am the buyer and you are the seller in an exchange, we don't know each other. If I am buying a contract, I'm buying it from the exchange, where the clearing house is the party that is responsible for my trade. That is the opposite side. And if you are the seller, you don't know me that I am the buyer, and you only trade with the market. That's why we say, oh, we went into the market and we bought and we sold in the market. So we don't know who is on the opposite side of the contract, but we know that our contract is on a given exchange and we are not worried about it. We don't worry about the counterparty risk because the exchange is our counterparty basically. And to trade in the futures market, as I said, you will be required to have a margin accounts, which will be used for daily mark to market to credit or debit the gains and losses on your future contract on daily basis. And there will be margin calls, and we will talk about it later. Any questions? Then we have swaps. So as we said, that swaps are advanced and complex form of forward contracts. Basically, they represents multiple forward contracts. So for example, if I have a swap where I am exchanging my fixed interest for floating, okay, interest, which we call a plain vanilla swap. So I am paying fixed and I am receiving floating interest. So let's suppose this swap is for 1 year, and every 3 months there will be this exchange. Okay, so I can see this basically for if every 3 months for 1 year, so that means there are 4 payments that I can expect, 4 net payments. So I can see it's a combination of 4 forward contracts, one expiring in 3 months, one expiring in 6 months, one expiring in 9 months, and one expiring in 12 months. So valuing a swaps, as we will see later on, in such a case will be equal to valuing this complex structure of forward contracts that have expiration spread in 3 months, 6 months, 9 months, and 12 months period. Swaps, as I said last time, that they are the most exciting form of derivatives because the way they enable you to replicate so many other concepts, even derivatives. The most common swaps are interest rate swaps. That was when originally swaps started. The first swaps were only based on interest rates, and then we have currency swaps, and then we have commodity swaps, and then we also have credit swaps. For example, CDS, credit default swaps. So we will be actually having a look at this. Can you all please make sure that your mics are off? Other types of derivatives include embedded derivatives. So how many of you know that a callable bond has a derivative inside it? A callable bond has is actually derives its value from 2 sources. One is the value of debt, and the other is it has what? Callability. The issuer can redeem it at a before maturity. What does that mean? I mean, like, you are right that it has the redemption right given to the issuer. So what does that mean? You know, when you buy a callable bond, what is a callable bond? Like, you see, let me say that the face value of the bond is $100. The coupon rate is 10%. The time to maturity is 7 years, but it is callable after 5 years, and the call price is the price at which the bond can be repurchased after 5 years by the company is let's suppose 102. Okay, so what does this information mean? That if I buy this bond of the company today, let's suppose the current market price is, or the issue price is $100. So it is exactly equal to the face value. I'm expected to receive 10% interest on this for the next 7 years. However, after 5 years, if the company deem it is appropriate, the company can buy this bond back from me for a price of 102. Why the company is keeping this callability option inside it? Because the company may expect that in 5 years time, interest rates may go down in the market to 3% or 4%. At that point of time, it will be not appropriate for the company to pay 10% interest. So what it can do, it can buy back these bonds from me and so many other people and issue new bonds that will be much cheaper, paying only 3% or 4% interest. So it will be paying only 6%. So it is ready to pay me £2 extra after 5 years and buy back this bond from me, because the interest rate, if they go down, they will enable the company to issue new bonds at a much cheaper rate. So this is callability option. So what is this, right? It is call option. So the company is basically keeping a call option. So when I buy the bond, I become the writer of the call and the company becomes the buyer of the call. Now it is not explicitly done, but whenever a company issues a callable bond and people are buying it or others are buying it, it is implicitly happening that you are not only buying the call, but you are selling a call option to the company, and the company is buying a call option from you, where it will have the right to buy the bond from you after 5 years or 7 years or whatever the callable period is for a given period of time. Okay, so this is here the right to call or the right to redeem is with the company, and the investor is writer. So when I invest in this callable bond, I am the writer of the call and the company is the buyer of the call. What is a convertible bond?
Is it a bond that can be converted into equity on maturity?
Yeah, quite right. So it can be converted into equity. You know the article that I shared last night about the margin call that Robinhood received from the clearing company uh, of $3 billion. So Robinhood did not had that much money on it. So what it did, Robinhood issued a convertible bonds, okay, that investors purchased and raised around, I guess, around $2 billion. So uh, what does that mean? That those investors who purchased Robinhood's convertible bond, they can convert their bonds into equity after some period of time. So if a company issues a convertible bond, so it is not only selling the bond to the investor, but it is also selling what? Call option to the investor. Why? Because the investor has the right to buy a certain number of shares of the company at a specified price after a specified period of time. So if this convertible bond issued by Robinhood is, let's suppose, for 5 years, and it can be converted into equity after 3 years. Okay, let's suppose I have a convertible bond that has a face value of $100. Okay, and right now the stock price of Robinhood in the market is, let's suppose, $10, and I say that this in 3 years time, let's suppose the convertibility option is in 3 years, and the option the bond is having a maturity of 5 years, and I say that the number of shares that it can be converted is 5 shares. Okay, so right now it is out of the money, because you see, if you convert your bond right now, it is not convertible even today, because you see you have to wait for 3 years. But if we look at the moneyness of this option, if you want to convert your bond into shares, you will get 5 shares, and each share in the market is worth 10, so that will be 50. So that's not a good thing to do. In 3 years time, if Robinhood's share price is in the market is $30, okay, and you convert your bond into 5 shares of Robinhood, you will have, for each $100 of bond, you will get $150 of shares. So that will be in the money. In 3 years time, if the share price of Robinhood is 15, it will be worth 75. So you will not exercise your right, and you will not convert from the bond into shares of the company. But this is a possibility. So you see, when the company like Robinhood has issued convertible bonds, so it is not only selling the bond to the investor, but it is also selling a call option. So in this case, if I am buying a convertible bond of Robinhood, I am not only buying a bond, but I'm also buying a call option. Okay, and that call option gives me the right to convert, in other way, buy the shares of Robinhood in 3 years' time at a specified price. Okay, then we talked about callable bonds. Then we also have puttable bonds. Okay, in a puttable bond, the investor has the right to sell the bond before its maturity. If in a puttable bond, the investor will be not only buying the bond from the company, but it is also buying put option, where the investor has the right to sell the bond of the company back to the company after some time, which will be specified in the bond indenture. And that gives, I mean, like, that particularly that will be quite useful when interest rates go up. When interest rates go up, the bond price goes down, and then put options become quite useful, because the bond price, when it goes down in the market, it will be a loss for the bond investor. So the bond investor, if it is if the put option is in the, I mean, like, is due and the time period has lapsed, so the investor can then convert, or sorry, can sell back the bond to the issuer. It is quite opposite to what we talked about for callable bonds. So we have callable bonds, we have convertible bonds, and we have puttable bonds. Is it clear? Any question? Okay. Next, we have options on derivatives. So we have options on swaps, which we call swaptions. Okay. And then we have options on futures, which we normally know as commodity futures. We will be talking about them later when we take on each specific topic in respective weeks. And then we have credit derivatives, and we will be talking about credit derivatives, particularly CDS is something that we will talk about, and we will also talk about CMOs, CDOs, and ABS and MBS securities. And this default option is already covered by credit default swaps. Then we have real options. If you remember what you did with CUDA or in your investment appraisal techniques, NPV, IRR. So real options are also there in projects. You can delay a project. So the option to delay a project, the option to expand a project, the option to postpone a project. These are all real options. For example, the option to expand a project, like for example, you can start a small business or a small project, and then you can actually sort of expand it. So that is equivalent to like a call option. Similarly, the option to postpone a project or like abandon a project, the option to abandon particularly will be considered as a put option. Now, the origin and development of derivatives market, I leave this to you to read. And I when I say you read it, it means that you must read it. It's important for you to have an understanding of how the derivatives markets have evolved and developed. This will be of particular value when you start writing about the question 1 on your coursework, because you will have an understanding of how the derivatives markets have changed their functioning over time, and what is important for any contract that trades on a market. So this is just only a historical review, so I'll leave that. Again, derivatives exchanges. So there are, it is, for example, if I look at it, there are a lot of changes that have taken place. For example, the CME Group and the Chicago Board of Options, most of them have now become like, they have merged or they have been acquired. So it keeps on changing. The market is becoming quite, I would say, competitive. So different exchanges are merging. And one of the reasons for this being the technology. You don't need a physical location. So now markets across different borders are being acquired or being, merged. because they know that it is not relevant anymore to have a physical location, but it's more like virtual and digital. And just if you look at this data, so that is around 20 billion contracts traded on world derivative exchanges, but this data is old. Okay, again, you see this is only till 2013. So a lot of changes have happened over time, and the derivative market have seen a lot of volatility, significantly increased over recent times. Exchanges are often for-profit companies. Okay, there used to be a concept of you know two types of markets normally used to exist. One would be an exchange that will be like a company limited by guarantee, and it will be a concept very closely to like you would say a cooperative society. So so the exchange would be owned by the members uh, of the exchange, okay, and they each will have guaranteed a certain amount of money in case the company goes into trouble, and they also contribute towards capital of the company. However, this is more like the mark. This is not. I would say a full public limited company. You know the structure of a company limited by guarantee. So it has had its limitations. And what has happened now, even in emerging markets and developing markets, that stock exchanges that previously used to be limited by guarantee have now become full-fledged companies, public limited companies or private limited companies themselves. And as a result of that, what is happening that you can buy the shares of these markets. You can be an investor. Of course, if they are private, so then you will be a private investor, and they are earning money. So like, for example, if you talk about the London Stock Exchange, so it is a subsidiary of a bigger group. And the London Stock Exchange itself operates as a company that is seeking profits, just like any other corporate entity. And that is why there is a lot of competition now, because nearly all exchanges around the world have become these profit-seeking enterprises, just like any other. So you have companies that are listed on stock market, and these companies, they have their own business models, and they make revenues, and they incur expenses, and they want to maximize profits. Same is the case with the market in itself, that where you trade, London Stock Exchange, New York Stock Exchange, or any stock exchange, that is also a profit-oriented enterprise. The exchange membership, particularly in this case, was originally limited to those, like who would also be the guarantors of the company. To be able to trade on a market, you need to have a seat. If we have the London Stock Exchange, okay, so if there are let's suppose 200 members on the London Stock Exchange, only these 200 members have access to what we call, if there was a floor of the market, so they will have access to the floor of the market. If I want to trade on London Stock Exchange, I cannot. Now I can do digital, but again, I need access through a broker who has access to the floor of the market some way. Now, if I wanted to trade on London Stock Exchange, I cannot go and trade on the floor of the market by myself. I'll have to use this member here, who will be a broker, okay, and who will have a representative who will be physically here if it is physical trade, which of course doesn't happen nowadays. So if I am selling, I will give my sell order to the member, okay, and who will be having a representation here. It is not necessary that if I am the member, I should be trading here. I can lease my or rent my seat to someone else, okay, And at times, members have been doing them. Most of the times, there have been instances that has happened. So if someone who is not a member will not have access to the floor of the market or uh, the trading execution in the market, whether electronic or physical, it will be only limited to those who have membership of the market. Is it clear? Next, we have standardization of contracts. So as we know that there are two types of markets, one is the exchange market and the other is the OTC market. And we know that the exchange market is standardized and the OTC market is customized. Now, the advantages of standardization and particularly how it works for derivatives is that standardization helps reduce cost. Why? Even if you look at large scale production, economies of large scale, if you have one standard product to produce again and again, it reduces your cost because the procedures will be like, the same standard procedures. However, if you have to make customized products, you will have to make changes in the product design, the labor, the machines, and other stuffs, and that increases your cost. The same is true for exchange listed standard contracts because they are standard contracts. You know the size, the underlying, the expirations, and all of this has been set by the exchange, so it's easy to trade, and it increases efficiency at the same time because everybody knows what a future contract on gold is, or what a future contract on a bond is, or what a future contract on a particular stock is. What are the delivery terms? What are the contract sizes, the unit of price quotation? All of this is known. It increases efficiency. On the other hand, for the OTC market, they are customized, so you will have to negotiate, you will have to spend time and effort in deciding on the terms and conditions, and each contract will not be the same as the other one. So it will not be easy to sort of compare two or three or four or any number of futures forward contracts in OTC market because they are customized to the needs of the two parties. And that, of course, affects efficiency. When we say standardization for a derivative contract, the future exchange or the option exchange will determine what will be the underlying. So, for example, there were no futures contract available on cryptocurrencies. If I talk about Bitcoin 2 years ago or 1 year ago. But then we saw that the CME, I guess, started to actually decide that now it is going to offer a future contract on Bitcoin. So, who decided to offer a contract? The exchange decided, and what on the underlying is a cryptocurrency. Expiration. So when will the contract expire? So normally, I mean, like, it's a 3 months period. So we have expirations. For example, let's suppose the one of the contract, let's suppose Microsoft is assigned to the let's make it like this, the March, June, September, and December cycle. So there are contracts that expire in March, there are contracts that expire in June, September, and then December. Another stock, for example, let's say Apple, may be assigned to a cycle where it is expiring in, let's suppose, Feb, for example, May, August, and November. So the exchange decides the expirations, and then we have the option exercise prices. So who decides that what exercise price will be used? For example, in the case of option, the exercise price for March contracts on Apple there are 3 exercise prices. So X1, X2, and X3. So you can purchase a call option or a put option where the exercise price is 120. where an exercise price of 125 is applicable or where an exercise price of 130 is applicable. So these prices, these are determined by the exchange, the exercise price. I'm not talking about the underlying price, but the exercise price. Exchange decides on this. So anybody who is buying a call option or a put option on Apple, for example, will have the same exercise prices in front of him or her. Then we have the contract sizes. So for example, how many shares will be there represented by one call contract? So if I buy one call contract, the size of that contract, for example, is 100 shares of Apple. So this is determined by the exchange. It is standardized. Anyone who buys one call contract or one put contract on a stock of Apple or Microsoft or any other, if the size is kept at 100, so that will be 100. If it is a gold contract, so what will be one gold contract worth? If it is a currency contract, so what will be the size of the currency contract? If I buy one contract on pound, let's suppose, or dollar or any other currency, how much will be this contract size? Let's suppose $100,000 or make it 100,000 euros. The unit of price quotation. So what will be the price at which it will be? I mean, like, how would the price be quoted? And that is an important. Will it be per kg? Will it be per per liter or per share? How would the price be quoted? That is an important consideration, and we will see how it varies over time later. Any question on this so far? Now, I have uploaded an article to Moodle on particularly the lock limits. And I would suggest that you read that. It's available on investopedia.com also. There are some good examples of how to understand some of the concepts that we have here, particularly related to limit moves and lock limit. Now, position limits is the maximum number of contracts that can be held by anyone. Now, why is this important? This is to manage volatility in the market and avoid, I would not say speculation, but excessive speculation. You and I know that it's very easy to buy and sell in derivative, buying future contract, selling future contract, buying call contract and selling call contract or put contracts are relatively cheaper. If Apple's share is trading at $120 today, let's suppose to buy one share you need, let's suppose 120. But if you want to buy a call option or a put option on this or a future contract, you might hardly need $5. So there is a huge amount of leverage involved, and people with little money can actually take big positions and affect the price direction. So a position limit is that how many of a particular type of contract, futures, forward, futures, options, call option, put option, that you can purchase on the exchange and keep with you at a time. So there are position limits that a single investor cannot hold more than a particular amount of a number of contracts on one side of the trade. Then exercise limit. So exercise limit is, let's suppose if I have 1,000 call contracts, okay, and let's suppose that is my position limits. At any point of time, I cannot have, let's suppose, more than 1,000 calls on Apple. So that is the maximum position limit I have. Now the exercise limit, for example, is that I cannot exercise more than 600 calls contracts in a single day. Okay, again, that is to, as I said, manage all this. Then we have price limits. So price limits again are used to actually manage this volatility and speculation, excessive speculation, I would say. So a price limit is how far the price can go up or go down in a single day. Okay, so the limit up is the maximum up move in the price of the contract that can happen in a single day. and the down move is the maximum down move in the price of the contract that can happen in a single day. And as I said, there are examples that are there in that article, so I would recommend you go and you read that article also. It gives you examples from both the financial products perspective, financial instruments perspective, as well as commodities. Then is the limit move. Now, for example, let's suppose if the move for a future contract, let's suppose the Apple price in the future contract is 130. So this is the future price today at the start, and the limit up is set at $145 and $115. So the price cannot go beyond 145 today and cannot go down beyond 115. So the up move is 15 and the down move is 15, basically 145 and 115. Now, let's suppose at 3:10 in the afternoon, the future price has fallen to 118. Okay, and the price changes to 115. So you see this 3 change has resulted in the price of the future contract hitting the limit downwards. So this will be considered as a limit move because this change has actually put the trading at halt. Whenever the limit up or the limit down is hit, that move is called the limit move and it will halt the trading. The trading will be stopped. Now, in most of the cases, this is done for some time, like 10 minutes, 15 minutes, like what we saw in the stock market in March 2020, when because of the COVID thing, the New York Stock Exchange was I mean, like, trading stopped for some time. However, after some time, the trading 15 minutes, the trading did start again. So I would recommend that you also read about the 4 times the market was forced to a trading halt in March 2020 and see how that worked then. Now, when this limit down or limit up move is hit, it is called and the trading stops, then it is called a locked limit. Now trading cannot take place because we see that the future contract has gone into a locked limit. No trading is possible at a price below this price if it is a limit down move that has resulted or a limit up move that has resulted, then no trading can take place beyond this price, unless if it after 15 minutes or 10 minutes, whatever the break is, if the trading starts at a price less than this or at a price more than this, then it's fine, trading will continue. But if there are no orders at a price less than 145 or 115, what will happen? Trading will be stopped for that day. So for that day, no trading will occur, because if the market has hit this move, orders are coming that are even further down. So the market will not trade at any price below this anytime today. However, if there are orders after the break and that enable trading here, it's fine. If the up limit is hit, there will be possibilities that orders can come at lower prices, then trading can start. If not, then the trading will be stopped for that day. Okay, so that is called a locked limit. However, in the same thing is called circuit breakers in stock market. So lock limit and circuit breakers are identical. The only thing is that in derivatives market we call it lock limit, and in stock markets we call it circuit breakers. Okay. Then we have physical versus electronic trading, and I hope you can recall the video I showed those of you who were attending the open days with me, and we had this video where we were showing you the physical trading on Chicago Mercantile Exchange and in the US. So most of the trading nowadays is electronic, but there was a time when physical trading was the norm, and I think there are only 3 markets in the world right now that still have physical trading pits where you can go and trade if you are the member of the exchange and you have access to it. And if you watch that video again, you will see how the trading pits look like. There is a documentary also available on YouTube, uh, which is a day in the life of a trader. So you can watch that also. So in a physical trading, what happens is that there is a trading pit, and each trading pit, if I want to buy or sell, for example, Apple's share are purchased and sold in this trading pit, and then Microsoft's are here, so there is allocation. So if I want to buy, I'll go there, and you will see on the floor of the market there will be hundreds and hundreds of people who will be trading. So if I want to buy or sell, I'll go there and I'll quote my price, and everything here is mostly in symbols. If you remember that video, and if you watch it again on Moodle on YouTube, you will see that the traders use signal for buying and selling call option and put option, and the number of contracts and the price. All of this is communicated through symbols. Okay. Now, this is also called as open outcry. Okay, when physical trading happens. And there is a possibility that when all this is taking place, there may be some errors. So for example, there are guys who are recording all the symbols from the different trading pits in the exchange. So they may make an error in recording or interpreting the symbols. So that can result in an error, and that error will be considered as an out trade. And this is what normally happens in physical trading. But this is not known much in the market. I mean, like, people don't know much about it, but this is one possibility that is quite regular in the physical trading platforms. And every time this happens, the 2 parties will meet and they will correct for it. As we discussed earlier, that nowadays most of the trading takes place electronically through electronic trading platforms. So this was the pioneering platform that was there for electronic trading by the Chicago Mercantile Exchange. And as a result of this, what we have seen is markets have achieved operational efficiency, allocative efficiency, as well as informational efficiency. You remember the 3 types of market efficiency that I say. Because of electronic trading, we see that transaction costs have nearly gone to 0. Robinhood and others, they don't charge you anything. Okay, now I've been saying that Robinhood doesn't charge anything to you as a broker. So how does Robinhood make money? Any idea?
Spread.
Okay, other than that.
They sell your data.
Sorry?
They sell data.
Yeah, good. Then other than that, you're right. What they do, they actually have deals with the brokers. If you have read about Citadel, that Robinhood has tried to protect Citadel, the guy who owns multiple financial institutions. So what Robinhood does is that it is actually channeling the orders through a particular financial broker. So it is getting money from there also, because the orders on the OTC market or the dealers market are executed by a particular broker. Okay, and that particular broker is then giving back some money to Robin. Do you get this? It's a free trading platform nominally, but effectively there are ways they earn money Otherwise, it would not be profitable. And you can't expect it to actually raise $2 billion or $3 billion in 2 weeks' time without nobody understanding its business model. So it is making money. So electronic trading has reduced what we say this thing, out trade frequency, because most of the trades are executed perfectly fine unless and until there are any glitches in the trading softwares or IT or internet, etc.